Krishna Memani of Oppenheimer Funds. Come in here and we'll talk to you about, did you do anything this morning? You get up, like me, it's 3 or 4 a.m. This is what we do. You get up, you got a global Oppenheimer Funds crew. Do you just sit around and go, sell this, buy this, sell this? Do you actually do something? Or was it like figure out basketball or something else? What'd you do this morning?
Basketball is interesting, but perhaps not as interesting as investing for us, I suppose. So we looked at the markets this morning. We definitely wanted to buy, but what we were waiting for is to make sure that there wouldn't be a better investing opportunity developing intraday. So we looked at some of the opportunities that were available, and the area of the market that we are focusing on, the U.S. at the moment, is the CMBS market, the commercial mortgage-backed securities market.
Why is that?
Because it has widened the most of all the credit sectors.
Widen means to the benchmark, it goes out, the yield's higher. You can get this, Marvin, if you would yield higher. This is narrow. This is wider, right?
Exactly. So all of these instruments are traded off of the U.S. Treasury market, and their spreads, so their overall yield relative to the U.S. Treasury market has widened. And we think that is somewhat unwarranted. And the reason it is unwarranted is because the overall U.S. economy is still recovering. And as long as that economy recovers, we think the commercial mortgage-backed securities market should do reasonably well. And
this is the opportunistic point. Here's chart 4. Thanks, Rex, for bringing that up. Bonds run for the exits. Panic. You know, we're all playing this up. I'm as guilty of this as everybody else in the media. We're running for the exit. BAA industrial to 10-year. It's backed up a little bit. What about corporate bonds? Is this an opportunity?
Clearly, it's an opportunity in corporate bonds as well. That said, corporate bonds have not widened as much as other securities in the marketplace. So if we didn't have a full invested position in corporate bonds, we would probably look at it. In corporate bonds, we would probably focus more on the high yield and the loan market than in the overall investment grade market.
I want to bring up this rewind right now. Earlier this morning, folks, we talked to Mohammed Al-Arian, and we discussed how the recent global crisis was affecting the markets. The view from Newport Beach.
If you look over the last few months, we've had the Middle East, now we have Japan, and for markets, this is a combination of a negative demand shock and a negative supply shock. So it is understandable that markets are being driven by top-down factors as opposed to bottom-up analysis. And we, as commentators, as investors, have to keep abreast because these are major global developments.
I love that quote, Christian, because he talks there about the media, the commentators, and all the blah, 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 the jawboning versus investors. What's the little guy do given this panic now? I mean, do they tighten up on duration?
You know, clearly one of the reasons you have duration in the portfolio is as a hedge in case something untoward happens. So clearly maintaining the overall duration profile of your portfolio is very critical, and these are the types of environment why you own that duration in the portfolio. That said, we think the overall tenor of the global growth hasn't really, it has come down a tad, but it hasn't really changed meaningfully. It probably shaves off a few tenths here and there in terms of global growth, but once we are past this incident in Japan, I think things would stabilize, and a lot of the spreads that have widened a great deal would probably come back in.
When they come back in, when we get through this, as we will, a resilient world, a resilient Japan, do you invest for coupon or are you investing for total return?
We clearly invest for total return, but recognize that spreads have tightened a great deal over the last 2 years. So as a result...
Excuse me, we need that. This is a break exclusive. There was so much jargon in there I could barely keep up. What he's saying is, let me translate this. He and all the other bond guys have had the mother of all 24 months, and now they actually have to work for a living. Okay, now that we got that out of the way.
Thanks for clarifying that. But that is indeed true in that spreads in the markets have tightened a great deal. So there are opportunities, but it's more coupon-related opportunities than substantial capital appreciation.
Let's look at this chart. This chart is one of our favorite charts. It's an elegant chart. The great moderation and flight to quality. Okay, there's a long-term chart of the 10-year full faith and credit coming down. We're remarkably on trend. I just did a seminar with John Macon and Pippa Malmgren at the Common Fund, and it was a hawks versus dove inflation. Where are you on this? Are you a hawk? Are you a dove? Do you wake up like Morgan Stanley? You know, we're all going to go to 4.5% 10-year, or are you calmer about things?
I think I'm more on the calmer, I guess, dovish camp. I think the economy is coming off of a very rough period, and we have plenty of slack in the system, and therefore it'll take a while before inflationary pressures build. That doesn't mean fuel prices can't go up. That doesn't mean food prices can't go up. But the overall core inflation, I don't think, is likely to go up in a big way. So I would say things are pretty sanguine. Doesn't mean we couldn't get to 4% when the Fed stops buying, but I think that would be, again, a buying opportunity rather than a reason to panic.
Are the Oppenheimer Funds buying Japan this morning? You must have had a strategic meeting on this.
We haven't. We can't really talk about specific trades that we are doing.
Why not?
But we are.
Jim, tell him he can't come back. Okay.
But we are definitely evaluating opportunities in Japan. You know, for example, one of our portfolio managers was looking at the life insurance companies, Nippon Life, for example. We think that that sort of a company offers tremendous amount of value because of the correction. Because of the correction, the shock of it, and all. Where's the 10-year yield going to be a year from now? 10-year yield would probably be close to 4%, but not substantially higher than that. Very good. Thank you so much. Krishna Memani.